Since August, most people would say the bond market has been creamed. You think the worst is yet to come?
Yeah, the bond market really is at least the fixed rate component of the bond market is due for a severe shock here once the Fed gets off the QE2 program and rates are allowed to float freely again, because there's a lot of inflation out there, and it's only the Fed buying program that's keeping the long rates at the level what they are today.
Seems like the spike in rates came just as Bernanke announced what he was going to do at Jackson Hole, and then once it was implemented in November. But you're saying that the Fed buying these securities is actually helping to keep rates down a little bit right now?
Yeah, it's keeping them at a level that the Fed wants to take the banks out at, and they want to preserve basically the profits that the banks have in that, because the whole purpose of the program was to rebuild the capital of the banks, and now you want to let them get out with their profits, and the Fed will end up holding $600 billion of treasuries.
Let's look forward to June now, when this buying program ends. What's your best guess that's going to happen then?
Well, I think the market will reflect the true nature of inflation that's out there today, and we're going to see rates start moving up quite smartly, and I would expect 1 to 200 basis points in the long bond rate.
In the last decade, you've just been a huge moneymaker for people who have followed your fixed income advice. You don't think the next decade is going to be like the last decade?
You're going to have to be more nimble. The traditional instruments for fixed income investors aren't going to be serving you well in an inflationary environment, and I think that's what we're looking at for the next few years, not just 1 or 2.
So you can't just buy paper with a coupon attached to it. What do you go into?
You have to go into things that can accommodate inflation. For example, stocks that pay a high dividend, the blue chip quality that will adjust for the inflation. Convertible instruments which will participate in the stock appreciation, or buy right closed-end funds,
right,
which sell call options and therefore can offer you a much higher return than the straight dividend that stocks are offering.
Any particular names where people could start their search for good ideas?
Yeah, for example, the closed-end fund area, EOS, Eaton Vance buy right fund,
right,
is one candidate where they're yielding over 7% and actually selling at a discount right at the moment.
How about utility stocks? Are those the high dividend type things you want?
Short term, they're probably going to take a little bit of a hit, but utility rates will be adjustable, and therefore they will be able to respond and preserve their value and their dividend rates.
All this talk of inflation makes one think of gold. You got a gold idea?
Yeah, absolutely. On the gold side, unfortunately, bullion doesn't pay any yields, but the Gabelli Gold Fund, GGN, does pay a yield of about 8%. It's invested mainly in gold mining stocks, and we find that they complement the gold prices quite smartly.
Energy, Canadian trusts, anything there?
Canadian trusts are particularly attractive now for tax-sheltered accounts, your IRA accounts, because the Canadian government will no longer be withholding 15% tax on those. So they are actually now ideal for tax-free accounts versus previously they were better for the taxable accounts.